Hey, what's up, my friend? So, I've been trading for more than 10 years now. Tried different strategies, systems, patterns, indicators, and whatnot. And looking back right now from today, there are three types of strategies that has stood the test of time. And if you ask me, these are the three types of strategies likely to continue to work in the foreseeable future. And this is why in today's training, I want to share with you what these three trading strategies are. So this is why today you will learn the three trading strategies that I believe will continue to work for the foreseeable future: mean reversion, momentum, and trend following. I will walk you through the concepts behind these strategies, the characteristics of these strategies, the pros and cons of these strategies. Because here's the thing. No trading strategy works all the time. No trading strategy will profit in all market conditions. They always have their pros and cons to it. So I'll share with you what they are. I'll give you the complete trading rules of all of these trading systems, the entries, the exits, the risk management, so on and so forth. And all of these trading systems, I've backtested them for 10 plus years or more. Some of them even as far back as 25 years. I'll also provide you chart examples so you can quickly understand these strategies and concepts. You might be thinking, but Ragnar, all these strategies and systems that you're about to teach, they're all based on back-tested results. In the real world of trading, things are different. Yes, I get it, right? Just because something works in the backtest doesn't mean that it works in the real world of trading, right? But I can dare say that the strategies and concepts that I'm about to share with you are things that I apply to my own live trading account. And here's the proof. This is the results of my own live trading account, and you can see over here, it's from 2019 till right now 2025, and over the last 5-6 years, I've been consistently beating the markets. And guess what? This account over here is using the same concepts, same strategies, mean reversion, trend following, and momentum, right? That you're about to learn in today's training. So I can dare say these are the stuff that actually do work in the real world of trading. So if you're ready, then let's get started. So in this section, you will learn a mean reversion trading system that has generated 2,834% over the last 25 years. So let's get to it. So what is mean reversion trading? So I want to make sure that we are all on the same page over here. So mean reversion trading is when stock price deviate from their average price. Because when they do, they usually revert back to the mean. I'll show you shortly what this looks like on the chart. And as a mean reversion trader, you look to profit from this snapback. So imagine this. Imagine there's a rubber band, an invisible rubber band in my hands. When I pull that rubber band and I let it go, what happens? The rubber band snaps back. So it's the same thing for stock trading. So as a mean reversion trader, what you're trying to do is this. You're identifying, in fact, let me just move on to the concept first. You're looking to identify stocks that are in an uptrend. Something like this. And then you wait for a pullback and you buy on the pullback. You're not waiting for confirmation, reversal pattern, or whatsoever. As a mean reversion trader, mean reversion stock trader, you are trying to catch the falling knife. Okay, you buy on a pullback, buy when the market looks bearish. And when the market makes a bounce, okay, you sell, thereby capturing this bounce, this quick profit over here. So this is the goal of a mean reversion trader, someone trading in the stock market. And of course, these concepts that I've shared with you, the idea, it is not enough, right, to develop into a trading system, because a trading system must have a fixed set of rules. When exactly do you buy? When do you sell? How much to buy and sell, and stuff like that. And this is where we move on into the trading system itself. So earlier, the mean reversion, the concept is more of a high-level strategy. So now we're moving into the system with exact trading rules. So we're going to be trading stocks in the Russell 1000 index, pretty much the largest 1000 stocks in US. So you can easily enter your trades and exit them with minimal slippages. Time frame is a daily time frame. And risk management, 20% of your capital for each stock and a maximum of 5 positions. I want to explain this one a little bit because I think many traders watching this might be thinking, man, Ragnar, what does it mean? Let me explain. So imagine you have $10,000 trading capital. What this means is that you can hold a maximum of 5 stocks, and each stock you will buy $2,000 worth of stock. So 2,000, 2,000, 2000, 2000, 2000. Okay, and if you buy 5 stocks, you will realize that all your capital will be used up, so there's no leverage involved. So let's say, for example, let's call it stock A. There's a valid trading setup and you want to buy. How much stock A do you want to buy? Well, you buy $2,000 worth of stock A because that's the maximum amount of dollar value you can assign to one stock. Make sense? Now, let's have a look at the trading rules of this system. So number one, the stock is above the 200-day moving average. So this is the criteria to define an uptrend. It's kind of like, you want to make love to your wife. You want to pop the question, you want to hint to her when she's in a good mood. Same for stock trading. When you want to buy stocks, especially if you want to make money on the long side, you want to make sure that the overall market, the overall stock is in an uptrend. So the way we do it is that the stock must be above the 200-day moving average. Next one, second rule. And by the way, some of you like to ask me, Rainer, should I use the simple moving average, the weighted, the exponential? My answer is this: it doesn't matter. It doesn't matter whether you're going with the SMA, the EMA, the WMA, the MMA, whatever. Because the concept is what matters. If you think about this, the difference between a 200 SMA, EMA, whatever MA, the value is going to be very minimal. Okay, maybe one could be, let's say, a value of 200 for the SMA, then the EMA, the value could be 200.5 or 201. It doesn't really going to change much. So really the concept is what matters. And I would be worried, or you should be worried, if someone tells you that it makes a big difference. Because if it does make a big difference, clearly the trading rules are over-optimized and the strategy, the system will likely not work in the real world of trading. So whether you go with 200-day simple moving average or whatsoever, it is not important. What's important is the concept behind it, which is pretty much one thing to define stocks that are in an uptrend. There are many ways to go about it, and in this case, I just simply use the 200-day simple moving average. Next one, the stock closes below the lower Bollinger Band. So this is the way to define the pullback. And again, it's not the only way. You can use RSI, stochastic, or whatsoever. But in this example for this system, I use the Bollinger Band. When that happens, you then place a 3% buy limit order for the stock. So this is to help us define stocks that are oversold. And the 3% buy limit order is based on the previous day closing price. Okay, just to be clear over here. So number 4, if your order is filled, you sell when the 2-day RSI crosses above 50 or after 10 trading days. So this is the criteria to exit your trade. So most of the time, you will exit when the 2-day RSI crosses above 50. I would say 80 to 90% of the time, you will exit through this mechanism. But there are times, right, when you capture a falling knife and the stock price just goes down day after day like diarrhea, and it doesn't even make a bounce. So this is where we want to have a time-based stop loss to cut our loss after 10 trading days, a maximum of 10 trading days. And this criteria will be used if this doesn't happen. So there are times, right, where stock price just diarrhea. You still have to hold that stock for 10 trading days and then sell it, right, if the 2-day RSI has not crossed above 50 within that 10 days. And finally, if there are too many stocks to choose from, select the ones that have increased the most in price over the last 150 days. So because you're trading stocks in the Russell 1000, there's 1,000 stocks that you can trade. So sometimes there are many opportunities lined up for you. What happens is that you'll be spoiled for choice, like a buffet. Oh, which one do I pick? So this is where the ranking system comes into play. You want to select stocks that has increased the most in price over the last 150 days because these are stocks that are the strongest. That's why they went up the most in price over the last 150 days. And these are the stocks that are likely to continue higher. So that's our ranking system. And finally, the Bollinger Band, we tweak the settings a little bit. We use 2.5 standard deviation instead of the regular 2 standard deviation for most charting platforms. When you insert Bollinger Band, it's usually 20-day moving average and 2 standard deviation. For this one, we go with 2.5 standard deviation. So in this case, right, we are looking for the stock to be, or rather to define it to be more oversold in that aspect. Now, let's have a look at an example so you can see how this trading rules look like and also how to add the indicators and adjust it on your TradingView platform. So I'm using the replay mode. Let me just see. Okay, looks better now. So first thing first, we need to make sure that the stock price is above the 200-day moving average. So you look for SMA, just click on this. I'm just gonna change this to 200 style. I like it black because that's how I define my 200-day moving average. So you can see the stock price is above the 200-day moving average. Our first criteria is met. In fact, if you need a refresher because you have a memory of a goldfish like me, number one, the stock price is above the 200-day moving average. Number two, the stock closes below the lower Bollinger Band. So next thing we need is the Bollinger Band. So look for Bollinger Band. And if you recall, the Bollinger Bands that we use, we tweak the settings slightly. We go with 2.5 standard deviation. So you can see over here, original settings was 2, so I'm changing it to 2.5. Okay. And then you would remember that it has to be closed below the lower Bollinger Band. So over here, you can see over here, the stock price did close below the lower Bollinger Band. So what we need to do now is to place a 3% buy limit order to see if we get filled on the trade. So what we need to do is to find out what is the closing price on this for this candle here. And then just multiply it by 0.97. So I went to get my calculator. So you can see the closing price is 27.71. You're going to multiply by 0.97 and you get 27.71 multiplied by 0.97, 26.87. Okay, and what I'm going to do is just going to illustrate on the chart where it's 26.87. I'll use this green line over here. Boom. Oh, it's red. Let me just change this to green to signal our entry, and the coordinates is 26.87. Okay, so what's going to happen is that if the next day the stock price falls to this green line, we would have gotten filled on the trade because we are placing a buy limit order with your brokerage account. So you can see over here, boom, next day the market gap down lower and obviously we're going to get filled. Depending on what price, you might get filled at a lower price compared to the limit order that you've gotten filled as well. So anyway, you will be filled on this trade. So now next thing to remember is what's the exit. Exit is when the 2-day RSI crosses above 50 of the 10 trading days. So the next indicator that you will need is clearly the RSI indicator. Relative strength index. I'm just going to change the settings so you can see how I do it. The length is 2 period. We don't need the moving average one, so just going to remove this and click OK. So at this point, you can see that the RSI value, it's actually 0.95. We are looking for it to be above 50. So let's see if it goes up higher or not. Still below, right? Right now it's 15, 13, boom, 71, you can see. So now the 2-day RSI is above 50. This is where we're going to exit this position, possibly for a loss. So now, as you can imagine this, right? The RSI value is only confirmed. This is only confirmed when the market closes. So of course, you can't exit your trades when the markets are closed. Well, you can trade after market hours, but usually you get very poor fills. So what we're going to do is we only exit this trade then at the next day when the market opens. Boom. So it opens over here, right at this price point. In fact, if you want, I can just use this tool over here and change this to red. Okay, and this is our exit. So we can see over here, we bought at this green one and we sell at this red level, and clearly this is going to be a losing trade. But the purpose of this chart is not to show you winners or let you think, oh man, this is the holy grail, you're going to win all the time. No, it's just to kind of like show you how the trading setup works, where we enter, where we sell, and whatnot. And of course, one trade doesn't mean a thing because it's just random luck, right, in the short term. So this is why when you have a set of rules, when you have a fixed trading system, you can run a backtest on it and see how this system has performed over the last, in this case, 20 over years. Let's have a look. Okay, so you can see over here, this is the equity curve of this trading system over the last 25 years, up about 2,834% over the last 25 years. Breaking this down further, you can see the month-on-month, year-on-year results. Like in 2000, January is up 12%, for the year is up 97%. 2024, the system made 29%. We have a few losing years like here. So 4 losing years over the last 25 years. Not too shabby. And for the detailed breakdown, you can see over here 2,834% since 2000. So annual return is about 14% a year. 66% winning rate, 33% losing rate. payoff ratio. This is important, so let me explain. So how we define payoff ratio is that we take our average profit divided by our average loss, and you will realize that for this system, your payoff ratio is less than 1. So what this means is that on average, your losses are larger than your winners. And you might be thinking, so Rainer, if that's the case, then how is this system still profitable? Well, the reason why this system still makes money in the long run, despite having the average size of their losses being bigger than the winners, is because of this. Your relatively high winning rate. You're winning about 66% of the time. So you can see that you're winning twice as often compared to losing, right? You lose 33% of the time and you win 66% of the time. And maximum drawdown is 27%. So what does this mean? So let me explain. This is again very important, especially when you're trading strategies, systems, or whatsoever. You want to know what's the maximum drawdown of the system that you are potentially trading. So let's say if you have $100,000 trading capital, and let's say over the last 10 years, the worst your capital went down to was, let's say, $50,000. And then eventually it went back up higher to, let's say, $200,000. So from 100,000 down to 50,000, we call this a 50% drawdown. That's the maximum drawdown that you have experienced trading this, let's say, this system, right, over the last X number of years. So from the peak to the trough, we want to measure how deep is that decline in terms of percentages. So the deepest, the maximum decline, we call that the maximum drawdown. And for this system is 27%. And to put things in perspective, if you buy and hold the S&P 500, let's say from 2000 to right now today, I believe your maximum drawdown for the S&P 500 is 55 or 60% thereabout. So this is to kind of like give you an idea of what's the maximum drawdown for a buy and hold investor in the stock markets. And moving on, the pros and cons. Let's talk about the pros and cons of mean reversion trading, because no trading system is perfect. So I just want to let you know what are some of the advantages and disadvantages that you will experience. Number one, you have a relatively high winning rate, right? Mean reversion trading systems, I generally see it, above 60% winning rate. Some even as close as 70% is doable as well. This type of trading strategy usually do well when the stock market is ranging or in a choppy bullish market, because if you imagine this, if the market is bearish, you are not going to get too many stocks to trade because most of them are going to be below the 200-day moving average in the downtrend, so you won't have too many trading opportunities. At the same time, if the market is very bullish going parabolic, you also won't have too many opportunities because there isn't a pullback that you can buy into, because remember, this trading systems you buy on the pullback. So if the market is very strong going parabolic, again, this system is likely to underperform. So usually it does well in a choppy or bullish but still choppy bullish market. This system tends to do well. The downside is you get the less than 1-to-1 risk reward ratio, because you've seen earlier the average loss is slightly bigger than your average profit. And finally, you would tend to give back profits in a bear market, or rather I would phrase it, you would tend to not do so well in a bear market. And give back profits in a bear market meaning that sometimes you could buy the stocks and then the market goes into a sudden fear, right? It drops like 10%, 20%, like for example the recent tariffs, right? So a number of your positions, right, are going to get hit when such a sudden decline in the stock market happens. So you would tend to give back profits, or you'll see your account go into a drawdown during this period. And of course, it doesn't go down forever, because if you recall, we have a trend filter for the stocks. The stocks must be above the 200-day moving average. So if the overall stock is in a bear market, going down 20, 30, 40%, by then you're probably in cash already. And for systems like this, you'll remain in cash till things reverse, and then you start going back long to look for opportunities again. Now, at this point, you might be wondering, man, Rainer, how do you go about backtesting your trading strategy? So how do you get so many trading ideas where you have a mean reversion strategy, you have trend following, your momentum? So if you're interested, what you can do is go down to my website over here, tradingwithrainer.com. Okay. And you'll be brought to a page like this. You'll see my face smiling at you. And what I want you to do is to download this free guide called the Essential Guide to Systems Trading. Just click on this orange button, enter your email address, and I'll send it to your email for free. In this guide, I will share with you the process I use to develop new trading strategies. I will share with you how I backtest my trading systems, the tools and resources that I use. So if you're interested to learn more, to dig more, go and grab a copy of this Essential Guide to Systems Trading. In this section, you will learn a momentum trading system that has generated 535% since 2016. So let's get to it. So what is momentum trading? So momentum trading is a strategy that goes long on market that have shown the best momentum, the strongest momentum. And the way we define momentum is very simple. It's kind of like, imagine like acceleration. How fast did something move over a given time period? So for trading, we're looking at how many percent increase did the asset price move over a given period. It could be over 2 months, 6 months, 12 months, etc. And the reason why we are looking for markets that have shown strong momentum is because it is likely to continue higher. So the concepts behind this strategy is to identify markets that exhibit strong momentum. I'll share with you shortly how we define momentum, and we're going to hold the position till momentum stalls or show signs of weakness. So let's have a look at this trading system. It's pretty unique and something that you might not have come across before. So this system, we will be trading the ETFs market, exchange traded funds, ETFs market. And the reason we do this is because I just want to give you a different flavor, exposure to the different types of trading systems out there. Can momentum trading be applied to the stock markets? Yes, I could go down that direction, but for this video, I figured, let's do something different. We'll trade ETFs instead. And again, these ETFs are readily available. You can easily find them through these different tickers over here. Like we are trading gold, the ticker is GLD. We are trading S&P 500, the ticker is SPY. Then we have TLT, which is the Treasury bond, and DBC, which is the commodities market. The time frame is monthly. How often do you come across a trading system that trades once per month? And the beauty about this system is you only need 10 minutes a month, and that's it. And you will have a system that has consistently beat the market. So I'll get to that shortly. And for risk management, 50% of your capital for each, my bad, this one shouldn't be stock, this one should be ETFs for each ETF. And a maximum of 2 positions. I think you're probably familiar with what this means by now, because I covered that in the previous system. If you are struggling with what it means, then just go back and recap. And because I'm a little bit of an OCD, I'm going to change this right now for each ETF. Okay. So let's have a look at the rules of this trading system. The rules of the trading system is really simple, as you can see over here. Just 3 lines over here. First one, the ETF is above the 200-day moving average. Why do we do this? Think about this. I'll give you 3 seconds. 1, 2, 3. The reason is simple. We want to buy or go long on markets that are in an uptrend. So markets that are in an uptrend and they have shown the stronger signs of the strongest momentum, we want to buy those markets. But first, we want to make sure that it's in an uptrend, and we do it by making sure that it's above the 200-day moving average. Second one, for the ETFs above the 200-day moving average, next thing we're going to do is to rank them according to their rate of change. Simply put, right, we want to rank them based on their price performance over the last 12 months. So let's keep it simple. Let's say 1, 2, 3, 4. Let's say ETF 1, ETF 2, ETF 3, ETF 4. Let's say ETF 1 over the last 12 months, it went up 1%. ETF 2 went up 2%. ETF 3 went up 10%. And then ETF 4, let's say, dropped 5%. Now ask yourself, which among these 4 ETFs, which are the 2 best performing ones, assuming that they are all above the 200-day moving average? I'll give you 5 seconds. 1, 2, 3, 4, 5. Okay, the answer is this one and this one, because they have the largest price increase over the last 12 months. And if you're wondering, how do I have that shown on the chart? Rainer, can you show me which indicator do I use? What is the rate of change? Don't worry, I'll get to that really shortly. And finally, the last one is just to go long the top 2 strongest ETFs, which is what I've just explained previously. Okay, now let me walk you through how to go about finding, or rather identifying this system, right, using TradingView charts. So first thing that we want to do is to remember we are trading these 4 markets: gold, S&P, bonds, and commodities. So what you can do is that if you want to trade this system, you can create a new watch list if you want. Let's see, how do we create a new watch list? Okay, over here, I would then, let's say, create a new list. Let's call this ETFs. Okay. And in ETFs, let's add in the 4 tickers that I've shared with you earlier. GLD is one, SPY is the other. The other one is DBC, which is the commodities, and we have TLT, which is bonds. Okay, we have all 4 ETFs. So now, this is done on the, I think I forgot to mention, on the first trading day of each month. So right now, as I'm shooting this video, it's like the 10th of July. So you should always do this, or rather preferably do this on a fixed trading day of each month. And for the rules of the system I shared with you, the backtest was done on the first trading day of each month. So the first trading, let's assume that, you know, whatever you're seeing now is the first trading day of each month. Okay, assume that is the first trading day of July. So how do you know which ETF to buy among these 4 over here? So if you remember the rules, number 1 is to be above the 200-day moving average. So let's get out the popular moving average indicator. I'll change this to 200-day moving average. Okay, there you have it. Okay, so we have number 1, GLD is above it, SPY is above it, commodities is above it, and bonds is below it. So we know that bonds is out already. So we just left 3 contenders: gold, S&P 500, and commodities. So among these 3, which 2 should we be buying for this month? So this is where we need to bring out our rate of change indicator. Just look for ROC or rate of change. Click on this. And this one, I'm going to change this to 12. Okay, and if you remember, this is a monthly time frame. We are looking for over the last 12 months, which ETF has increased the most in price over the last 12 months. This one, I'm just going to change this to a monthly time frame. And then at this point, I am going to look at the ROC value, the rate of change value, which is over here. So I'm going to buy the 2 strongest one for this month. So in this case, I can see that gold is 34. Again, you can use an Excel spreadsheet or a document just to write somewhere in case you don't forget. Gold is 34, okay. You look at S&P 500, it is 13 as shown over here. And finally, if you look at DBC, which is commodities, the value is -1 over here. So this is no brainer, right? So this means that for this month, we need to buy 2 ETFs, which is gold and SPY. And this is the other 2 ETFs that we should be buying for this month if you were to trade this system. And how much of gold and SPY should you buy? Again, very simple. We are going with 50% position size and a maximum of 2 positions. So simply put, if let's say you have $10,000, you'll put $5,000 for this month in gold and $5,000 in the S&P 500 for this month. And that's it, right? This is the trading system, the exact trading rules. And this is why I said that you can trade this system in less than 10 minutes per month. Now let's have a look at the results of this trading system and see how it has fared since 2016. Oh yeah, one thing, before I get to the results, I also need to talk about the system. When do you sell the system, or when do you sell the ETF? So very simple, you only sell your ETFs when it drops out of the ranking. So if it stops being let me just go back to the rules. If it stops being the top 2 strongest ETF, you sell it and then replace it with the next strongest one. And of course, you also sell it if the ETF goes below the 200-day moving average, you would sell it as well. But let's say, for example, gold and the S&P, over the last few months, it has been very strong. So if you trade this system, you realize that for the past, I would say 6 months or so, there's no trades at all because you're just consistently holding gold and the S&P, because when you keep rolling, or rather you keep scanning or running the system each month, you realize the positions is the same. You're still going to be holding S&P and gold. Let's say next month come August, and you do what I've just shared with you, realize that S&P and gold is the ones that you should be holding for the month as well. But if you're already holding it, then there's no reason to sell. Just continue holding it. And if that's the case, you'll probably be done in like less than 5 minutes for the month. Okay, so this is a monthly trading system. Don't forget that. And now if you look at the rules, or rather the results, you can see this is the equity curve of this trading system. And if we drill it down deeper, you can see that since 2006, in case you're wondering why did we run this backtest since 2006, is because some of these ETFs, they are not available before 2006. So the earliest I could start is 2006, which is not bad because it's before the 2008 financial crisis. So you have the chance to, test this system on multiple crises like the 08-09 financial crisis, Russia-Ukraine war, COVID, etc. And for this system, 2006 is up 15%, 2024, the most recent year, up 26%, and we have a few losing years in between, like in 2011, and this one is 2015, and here as well, and here as well. And the losing years are pretty shallow, if you ask me. It's just single-digit losses. And later on, I'll share with you a trading hack, a trading tip that I think most retail traders do not know on how you can actually reduce the number of losing years to just a handful, right? I'll share with you that technique later on. So this is the results, and if you break it down even deeper, you can see that since 2016, it's up about 535%. Annualized basis is about 10% a year on average. Winning rate is close to 60%, losing rate is about 40%. Your payoff ratio is 1.13, so this means that your average winners is slightly larger than your average losers. And maximum drawdown is 22%. Again, we talked about what is drawdown earlier, so again, go back and watch the video if you missed this part. And to conclude this trading system, the pros and cons for momentum trading, and in particular this ETF trading system, I won't say this is not a pros and cons for momentum trading in general, because momentum trading can be applied to stocks, and clearly the pros and cons will change accordingly. But for this system, the ETF one that I just shared with you, the monthly trading system, number one is that minimal time required, 5 to 10 minutes per month. It's all you need to trade this system. And in fact, I shared with you step by step how to actually execute it earlier. There's little correlation to the stock market, because even if the stock market is down, it's bearish, you could still be making money for the year. As you've seen earlier, you see the results earlier. Let's say we have 2008 financial crisis. This system is up 15%. 2020 with COVID, we are up 18%. 2022 with the Russia-Ukraine war, in this case, we are down 3%. So there's little correlation to the stock market. And the reason being is that even if the stock market declines or is in a bear market, this system can go into safe haven assets like bonds or gold, which, let's say, when the overall stock market is underperforming, other assets, if they are performing, this system will switch to those assets that are performing during those crisis period, during those recessionary period, and that's how this system can still make money even though the stock market is bearish. And the downside to this system, I tried to think about it, but really the downside could be there's really nothing much to do. For traders who want more action, you won't get much action from this system. And another thing that I added previously but I removed is that this system is, I would say, the returns are kind of like average. I mean, it's not like mouth-watering, wow, 20-30% a year. It's about 10% a year annual returns. Pretty average if you ask me, but again, this is not 10% for all types of systems under momentum trading, because if you apply momentum trading to the stock markets, your returns is going to be higher. So this is why I didn't put the returns average over here, because I didn't want you to think that momentum trading strategy, the returns are only average. So I removed that portion out. But for the ETF, this ETF systems, right, I would say that, yeah, the returns for this system is kind of average, but you have to bear in mind, right, even though the returns is about 10% a year, not super wow, the maximum drawdown is pretty low. It's only 22%. So if you think about it, since 2016, I believe the S&P 500 have much deeper drawdown than 22%. So again, right, whenever we look at returns, we always have to look at it returns relative to the risk that comes along with it. Okay? Okay, so in this section, you will learn a futures trend following system that has generated 2,864% over the last 25 years. So trend following, what is it? So this is a trading strategy that originated from the futures market. So this is why it's called futures trend following. And it's used by famous traders, you know, the turtle traders, guess what? They are trend followers. Market wizards like Ed Seykota, and I don't know who else. I've read a number of them, right? They all are trend followers as well. So this trading strategy has been around for a long time, and it's proven to work, and there's a good chance it will continue working for the foreseeable future. So this is a strategy that allows you to ride trends across different asset classes. You can profit in bull and bear markets because you will go long and short, and you're trading different asset classes like indices, bonds, currency, metals, soft commodities, etc. So this is actually one of the secret sauce. Yeah. So let me just walk you through the concepts behind this strategy. So number one, you want to be trading as many markets as possible because it increases the odds of you capturing a trend. So earlier I've shared with you the different types of markets we trade, and of course, I shared with you over here are the different types of markets. Like currencies itself is not one market. You can have multiple currency pairs, euro dollar, pound dollar, Aussie dollar, blah, 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 right? Maybe even 10 or more. Same for metals. You have gold, silver, copper, etc. So you can see that all these different asset classes will give you many markets to trade off. And like I've said earlier, we are pretty much going to buy markets that are in an uptrend. We go long in an uptrend and we go short in a downtrend. And we will ride the trend till it ends. And the reason, or rather the way we ride the trend, is using this thing called TSL, a trailing stop loss. And again, later on, I'll share with you the indicators that you can use on TradingView to execute it. So let's talk about the trend following system that you're about to learn. So as mentioned, we are trading across different markets. So these are the specific markets that I've put over here that will be used right for the backtest later on. So currencies, we have pound dollar, dollar yen, Aussie dollar, euro dollar, dollar against the Chinese yuan. So I'm not going to go through them. You can read it for yourself. Time frame is the daily time frame, and our risk management is 2%. So what this means is that when we put on a trade, and even if the trade goes against us, we'll lose about 2% if it hits our trailing stop loss. It's not guaranteed 2% because we are trading on a daily time frame and we are waiting for the candle to close. So sometimes the loss might be a little bit more, like 2.2, 2.3, 2.4, 2.5%. It is possible, but it doesn't happen often. So these are the parameters that I'll be using for backtest later on. Now let's have a look at the rules of this trading system. It's really, really complicated. So brace yourself. You ready? Let's go. Ta-da! That's it. Just 2 lines. Yeah. So to go long, we will simply go long when the price closes the highest over the last 200 days. So simply put, right, we are looking for the highest closing price over the last 200 days. If the market makes the highest closing price over the last 200 days, we go long. And we have a 6 ATR trailing stop loss. ATR stands for average true range. This is a volatility based trailing stop loss. And to show you how this looks like on the chart, it will look something like this. Let's say the market goes up, comes down, and let's say this is the highest price point over the last, let's say this is over the last 200 days. If the market goes up and it breaks out, we go long. Let's call it L. And we ride the trend till it starts to reverse, and then over here we sell, thereby allowing us to capture the meat of the move. Let's call this MOM, not mum, but the meat of the move. So that's the idea behind trend following, and this is a long example. A short example is just the inverse. We go short on the breakdown when there's a lowest close over the last 200 days. So something like this, it closes below the lowest closing price over the last 200 days, we go short, we ride the trend down till it ends. Over here, let's say reverse, and we buy back over here, so thereby allowing us to again capture the meat of the move over here. So this is in essence what futures trend following is about. And what about the trailing stop loss? Well, how do we know when exactly to exit the trade? So this is where I'm going to walk you through a few examples so you can see this in action. Now let's have a look at some examples, shall we? So the first one is a trading setup on coffee. Okay, and a couple of indicators that you will find it useful. Let me show you the first one. The first one over here you can see is the Donchian channel, but this one is actually modified to plot the closing price. So where do you find this? I actually developed this one myself using an AI. So just look for Donchian channel, and this one is called you can be able to find this one bracket closing price. So that's the one I'm using. Okay, and it looks something like this. The settings over here, just change this to 200, and you should have something that looks something like this. So if I think it should be quite simple. Donchian channel closing. Let's see what pops up. Oh, there you have it, right? Wow, my name here. Anyway, yeah. So this is the one. Okay, so I'm just going to remove the extra one. There you have it. So feel free to use that. And next thing is, okay, so you look at it at this point, you can see that this market, coffee, we're waiting for a setup and entry trigger to go long. So when the price touches this blue line, so this blue line over here demarcate or highlights the highest closing price over the last 200 days. So if it closes into this blue line over here, it's an entry trigger to go long. So what happened next is kaput. There we have it. This candle, the market has closed, right? It's now at this point, it's now closed the highest over the last 200 days. And since now it can only be confirmed after the market has closed, you can't trade after the close unless you want to do after market hours. Don't recommend that. wait for the next trading day to open, and then you trade it. So put, right? Next day, market open over here, and that's where you go long. Right? This opening price, you go long. Now the question is, how do you then trail your stop loss? So this is where the second indicator comes into play. This is a chandelier exit. Okay, so if you want to look for it, I think you can just go to trading view. I believe I used this one from this one over chandelier exit. Yeah, this is the one I used. Yeah, they have it look similar. I'll remove the duplicate. And the settings are over here, 6 ATR and 20 period. Click OK. And there you have it. You have this green line that pops up at the bottom. So what you're going to do is to trail your stop loss. So when this market closes, let's say you suddenly reverse and closes below this green line, okay, you exit the trade because your trailing stop loss is hit. It has hit 6 ATR trailing stop loss. So in this case, let me just fast forward. Okay, so this one I have to be honest, I cherry picked this chart to show you how it's like riding a trend. Looks easy on the chart, but remember this is a daily time frame. You have to endure all this ebb and flow of the market. You know, you can see it breaks out, it makes a pullback, almost hitting your stop loss. You still got to hold this trade, you know, and then eventually breaks out higher, makes another pullback, heads up higher. Again, almost hitting your trading stop loss, and then go kaboom. So that's the nature of trend following. There's a lot of battle of your emotions, if you ask me, especially those of you who are new to trading. This is a strategy that, again, not most new traders is able to handle, honestly speaking. Okay, then you can see over here, let's see when does it break below the trailing. There, over here. Finally, on this candle over here, the market breaks and close below your trailing stop loss, which is over here. And since the market is closed, you can't exit. So your earliest exit will be on this candle over here at this opening price. This is where you sell this position for a nice profit. Okay, so this is how the futures trend following system look like. So, and there you have it, right? This is the idea behind futures trend following. And now, since our rules are objective, we can look at the results over the last 25 years. So you can see over here, this is the equity curve I shared with you earlier. And month on month, year on year, this is where it's important. Have a look. So you can see that as a trend follower, you're not going to make money every month or every year. I think same goes for all trading strategies. Nothing works all the time. But what's remarkable about trend following, in particular futures trend following, is that during a crisis period, during a recession, when the stock market is taking a beating, this strategy usually does well. You can see in 2000 with the dot-com bubble, up 22%. 2008 financial crisis, up 65% for this system. 2020 with COVID, up 8%. No, not huge. 2022 with Russia-Ukraine war, up 25, or rather 56%. So you can see that this is a system that thrives during difficult market environment. And if you look at the matrix, total return 2,864 since 2000. So annualized basis is about 14% annual return. Your winning rate is about 45%. You can see that it's less than half. So you're actually losing more than half the time, or rather, you're losing more than half the time. Yeah, correct. You're losing 54% of the time to be exact. Your payoff ratio is 1.74. So you can see that on average, your gains are larger. Pretty large, right? Relative to your average losses. And your maximum drawdown in this system is pretty steep, 37%. And it's not out of the norm, right, to see drawdown exceeding 40, 50, or even 60%. So they are trend following hedge funds. They have maximum drawdown of, in excess of 50%. And that's really the cost of being a trend follower. The drawdowns are not fun to go through. It's painful. It will test your emotions. It will test your resilience. In fact, let me just go back to, let's see. All right, I have all this data exported on Excel. So you can see over here, there's all this data exported. You can see that as a trend follower, there are periods where you just have to kind of like suck it up, right? You can see over here, since over here, made a new high and then kind of like, drawdown for the next few years over here. Same thing for this, made a new high over here, and then you have to go for drawdown for a few years. It might look short on this chart, but this is like a few years. It's not like a few weeks or few months. So as a trend follower, your winning rate is low, as well as, you have to be able to endure this lengthy drawdowns. So pros and cons of futures trend following is number one, there is no correlation to the stock market. So this is a good thing for those of you who are, let's say, stock investors, stock traders. You want a system or strategy that is diversified. Futures trend following is something worth considering, because later on I'll explain why this is the case. This usually does well in a bear market, as you've seen earlier. The downside to this is that this system, this strategy has a low winning rate. Generally, trend followers winning rate are between 30 to 45%, and it's difficult for most traders' psychology, especially if this is the only trading system that you trade. It's really going to test your heart and soul. Okay, so but that's it. There are things that you can do to kind of alleviate this pain, especially if you have multiple trading systems, or if, let's say, you are long the stock market. You could be an investor, a growth investor, value investor. If the stock market is bullish, your stock investments are likely to make money. And trend following, maybe the period doesn't make or do it that well, doesn't matter. At least your stock investments or stock trading is, providing cushion for it. At the same time, when markets are bad, when your stock investment portfolio take a hit, guess what? Trend following will shine. And so this means that your losses from your stock investment will not be as painful because you have trend following. Make sense? Next up, let's talk about the holy grail of trading, because this is something that I believe 90% of retail traders have never been exposed to before. When I realized this concept many years ago, it blew my mind. So I want to share this with you. It's really powerful stuff. Okay, so the holy grail of trading is this. It's possible to actually reduce your risk and improve your returns by combining multiple trading systems. It will improve your risk-adjusted returns. So what does risk-adjusted returns means? So let's say there are two strategies, strategy A and B. Let's say the annual return, strategy A is 10%, B is also 10%. And the maximum drawdown of strategy A, okay, let's say it's 20%, but strategy B, the maximum drawdown is only 10%. So if you look at these two strategies, most traders will say, oh, right, no, they're the same, man. We both have similar annual returns, 10% only. But no, strategy B is a superior strategy because it has a better risk-adjusted returns. Both earn 10%, but strategy B has lower risk because the maximum drawdown, in this case, is only 10%. So this is one way we can look at our risk-adjusted returns. At the same time, let's say both strategies have similar risk. Let's say strategy A and strategy B. Let's say in this case, their maximum drawdown, let's say for strategy A is 20%. Strategy B, the maximum drawdown is also 20%. Strategy A, let's say in this case, it has a 20% annual return, but for strategy B, it has a 40% annual return. So in this case, strategy B is a superior strategy as well, because for the same level of risk, strategy B can give you higher returns. So this is what we mean by improving your risk-adjusted returns. And let me just show you this table and you'll see what I mean. So if you look at this, right, over here, I have two trading systems over here, the mean reversion and the momentum. Basically, the two systems I shared with you earlier. And on its own, both of these systems have losing years. Mean reversion lost in money in 2014, 2019, 2016, 2022. Same for the momentum. Also has 4 losing years, here, 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 and here. But what happens when you don't trade any of this system in isolation, but trade both of them? Let's say you have a 50-50 allocation to both of this trading system. So let's say you have $10,000, you allocate 5,000 to the mean reversion trading and 5,000 to the momentum trading system. What will happen? If you look at it, the performance over the last, from here to here, you can see that you have made money almost every year and just one losing year, a minuscule 2.4% in 2022. So can you see how powerful this is? The concept of having multiple trading systems. And that's the reason why I trade multiple trading systems, because I want to utilize the holy grail of trading to improve my risk-adjusted returns. And it's possible. When you have multiple trading systems, you can make a profit almost every year, whether it's a bull market, a bear market, or even during a recession. Okay, before we sum up today's video, you probably have questions for me, and these are some of the frequently asked questions that I get from traders. Number one, how much capital do I need to get started with systems trading? So I've shared with you 3 of the trading systems here today, and for the momentum trading system, for the mean reversion trading system, I believe you can get started with as little as $3,000 or $4,000 and still have proper risk management. For the trend following system, that one requires more capital. If you can trade CFDs or forwards, then you could get started with, I would say, $20,000 for the trend following system. And if that's too much for you, then you can always stick with the mean reversion and the momentum trading system that I've shared with you earlier. Number two, what's the difference between momentum trading and trend following? I get it, right? These two concepts, they're actually quite similar, and I agree. But let's break this down and maybe shed some light on the difference between the two, in particular, the two systems that I've shared with you earlier. So number one, for momentum, is that we go long only, we don't go short, whereas the trend following system that I shared with you, we go both long and short. For momentum, we exit our trades when momentum stall or when it starts to weaken. Whereas for trend following, we only exit the trade when it hits our trailing stop loss. So this means for a momentum trading system, the trend could still be intact, okay? And you could possibly still exit the trade because momentum is stalling, even though the trend is still intact. So that's the difference again between momentum trading and trend following, is the exits that we spoke about is different. Next one, what about this one? For mean reversion trading, isn't it dangerous to trade without a stop loss? Or maybe even momentum trading, isn't it dangerous to trade without a stop loss? So here's the thing, both of these trading systems, we are not using leverage. So if you think about this, for the mean reversion trading, for the account to, let's say, go to 0, you need to pick 5 stocks from the Russell 1000. And the Russell 1000 are the top 1000 largest stocks in the US. And what are the odds of you picking 5 of these stocks which are in an uptrend and all 5 going to 0? I've been trading mean reversion for a number of years now, and I don't even have one stock, going to 0. Yeah, you can experience, stock declining 30, 40, 50% decline, but going to 0 and all 5 going to 0, it has never happened to me. And based on our backtesting over the last 25 years, never happened as well. So the odds are pretty slim that, you'll bust your account trading this system. And at the same time, even though you don't have a stop loss, meaning a stop loss in the traditional sense, a price-based stop loss, remember you have this thing called a time-based stop loss, because we hold a trade of a maximum of 10 trading days for the mean reversion trading. And if the stop doesn't hit our exit criteria, which is the 2-day RSI above 50, we will still exit the trade. So yes, we don't have a price-based stop loss, but we have a time-based stop loss. So we still have exit plans. Next one, can these strategies be applied to other markets? So what I've shared with you over here, I can't say for sure how it's going to perform on the other markets. Like for example, mean reversion trading, how does it perform in the Forex market? Well, I have no idea. I've not tested it before. So this comes down to, again, doing the work, right? As a trader, as a systems trader, you have to take the ideas, the concepts, and test it to different markets and find your edges out there, because there's a good chance, there's a possibility that one concept that work in a particular market could also work in other markets, but you never know for sure, so you have to test it. And of course, I have seen many times that just because one system or strategy work in one market doesn't mean it's going to work in other markets. So this is why you have to test. It's so important. And finally, right, where can I learn more about systems trading? So I believe I spoke about this earlier. So if you want to learn more about systems trading, highly recommend you go down over here, tradingwithreiner.com, which is my website. Yep, I'm shameless over here. And grab a copy of this book called The Essential Guide to Systems Trading. It is free. Okay, and this guide is really where we will talk more about systems trading, the tools and resources that a systems trader would use, what backtesting software to use, where to get your data, and if you do not know how to code, how can you go about doing it? And I also share with you my own process to always get new trading ideas and strategies for new systems to test out. So grab a copy of this guide, it's free. And yeah, that's pretty much it, right? So with that said, I've come to the end of today's trading. A bit longer than usual, but hopefully you found it useful. If you do, smash the thumbs up button, subscribe to the channel, and I'll talk to you soon.